Most traders don't lose money because they can't analyze charts or read indicators. They lose because they chase motion, not momentum. The market flashes what looks like a golden opportunity, a sharp breakout, a sudden surge, a candle that screams, "It's happening," and the crowd dives in head first. But that first breakout is almost never real. It's bait. It's the market's way of testing who's impatient enough to act on emotion instead of confirmation. Jesse Livermore saw this long before most traders even understood what a trap looked like. Watching the tape in the early 1900s, he noticed a cruel rhythm repeating over and over again. A stock breaks resistance. Traders rush in. Prices briefly pop, and then the same stock collapses, taking the crowd's money with it. The professionals weren't buying that first break. They were selling into it. Livermore called the next move, the one that came after the fake out, the second break. That's when the real money stepped in. That's when the trend was proven, not promised. He used to say, "The first move is for the amateurs. The second move is for me." It was more than a line, it was a philosophy. Livermore understood that every major trend begins with deception. The market's first job isn't to reward your readiness. It's to test your discipline. It lures the restless and punishes the impatient. A breakout appears. Volume surges. Financial news outlets light up with predictions, and within minutes, the entire emotional spectrum of greed and fear floods the crowd. The amateurs act first, driven by the illusion of missing out. They're reacting to motion. But motion isn't momentum. Momentum is motion with intent, confirmed by the market itself. And confirmation doesn't appear in the first break, it appears in the second. Livermore described the process like watching the ocean. The first wave rushes up the shore, impressive but unsustainable. Then the water recedes, testing whether it can rise higher. Only if it pushes back again, stronger and steadier, do you know the tide has truly turned. The market behaves the same way. That first rally looks like a wave of strength, but it's often just a gust of enthusiasm. The real move, the one that carries profits, is the second push after the pullback. That's the second break. It's not about being early. It's about being right. He would spend hours studying how stocks behaved after their initial breakouts. Some would surge past resistance, attract attention, then drift back down quietly as volume evaporated. Others would retrace slightly, hold firm above a previous pivot point, and then suddenly ignite again with renewed strength. That was the signal he waited for. The second breakout wasn't just a price event. It was proof that demand overwhelmed supply, that professionals were accumulating, and that the market had chosen its direction. Livermore didn't trade guesses. He traded proof. To most people, waiting looks like hesitation. But to Livermore, it was mastery. He understood that being early often meant being wrong. If he waited for confirmation and the move never came, that was a trade he didn't have to lose. The market gives you a test, he'd say. It's not your job to pass every one. It's your job to recognize which ones matter. The second break was that test of truth. The first break was noise. The second was signal. Consider how this plays out psychologically. Imagine a stock that's been quiet for weeks, suddenly surging through a key level. The first break pulls traders in with emotion. They see green candles and think, "I can't miss this." That thought, "I can't miss this," is the first sign of a losing trade. The professional sees the same movement and thinks, "Let's see if it can hold." That one word, "if," is the wedge between amateur and professional. When price inevitably pulls back, the crowd panics, convinced they were wrong. They sell, but Livermore waited. He wanted to see whether the market absorbed that selling, whether it built a new base, whether it proved strength. When price rallied again, breaking past the old high with cleaner momentum and rising volume, that's when he acted. The crowd had been flushed out. The professionals had taken control. Livermore's secret wasn't speed. It was patience weaponized. He knew that the market's first move exists to trigger emotion, not signal direction. The first break wakes up greed, fear, and hope, all the energies professionals use as fuel. He watched the tape like a hunter watches tracks in the snow. If a stock ran and pulled back without panic, If the selling looked absorbed, he knew something deeper was happening. The second break, when that same stock moved again through resistance, was the moment of truth. It wasn't just another uptick. It was a shift in control. This waiting goes against every instinct you have as a trader. The market conditions you to believe that action equals opportunity. But Livermore discovered the opposite. Inaction often precedes accuracy. The amateur feels anxious when the market pauses. The professional feels calm. The amateur needs to be in the market. The professional needs to be right in the market. That distinction builds fortunes. There's a story of Livermore trading in 1907, during one of Wall Street's most volatile years. A railroad stock had been climbing steadily. One morning it broke to a new high on excitement and rumors of strong earnings. The crowd piled in. Livermore stood aside. 2 days later, the stock slipped, erasing nearly all its gains. Newspapers called the rally over. But Livermore noticed something: the stock didn't fall below its last pivot point. Selling pressure vanished. When the tape showed volume returning, and the price pushed back through the same resistance level, he entered decisively. That was the second break. Over the next month, the stock soared 40%. The amateurs were gone. The professionals were in. Livermore made more on that one delayed trade than most did from chasing 10 first breaks. He wasn't guessing. The stock, listen, he was waiting for the market to reveal itself. And that's the part most traders never learn. The market doesn't hide truth. It just delays it. The first move is a question. The second move is the answer. And if you're too busy reacting to the question, you'll never hear the answer. Every deception in markets follows the same rhythm: excitement, exhaustion, confirmation. The crowd rushes in on the first sign of life. The market tests their conviction. And only after the weak hands are shaken out does the real trend begin. This pattern repeats across decades, markets, and generations because human psychology never changes. Livermore didn't fight it. He used it. He realized that waiting for the second break wasn't about missing opportunity. It was about aligning with truth. When a market shows its second face, its revealing intent, that's when Livermore acted, not before, not after, but precisely when proof appeared. And yet, his rule sounds deceptively simple: wait for confirmation. But simplicity is what makes it so hard. Simplicity demands restraint, and restraint demands faith in your process. Most traders can't handle that. They feel the need to do. Livermore built his fortune by mastering the art of not doing until the moment of clarity. He turned patience into precision. He wasn't late. He was deliberate. He once told a colleague, "The trick is to wait long enough for the market to show its hand, but not so long that you doubt your own method." That's the razor's edge of professional trading, trusting patience without slipping into paralysis. The second break rule gave him that balance. It wasn't mechanical. It was observational, psychological, and deeply disciplined. The irony is striking. By entering later, Livermore often profited earlier. Because while others were stuck nursing small losses from false starts, he was already compounding into confirmed moves. The amateur's obsession with being first ensured he'd rarely finish. The professional's focus on confirmation ensured he'd rarely fail. That's why Livermore said, "It's not the thinking that makes money. It's the waiting. The waiting creates clarity. The clarity creates conviction. And conviction, when acted upon at the second break, creates profit." So, the next time you see a market breaking out, remember this: the first break is a test, not an invitation. Let others rush in. Watch the reaction. See whether the market holds its ground, whether volume confirms, whether weakness is absorbed. If it can survive its own pullback, you're no longer trading hope, you're trading proof. That's Livermore's timeless edge. The understanding that markets move in layers of truth. The first layer is illusion. The second is confirmation. Only those patient enough to see both ever get paid. Because in trading, as in life, it's not the one who acts first who wins. It's the one who waits for proof. Jesse Livermore didn't rely on charts or fancy indicators to make his trades. He didn't analyze moving averages or oscillators. He traded behavior, the real-time psychology of the market, revealed through the tape. To him, each print, each volume spike, and each price pause told a story of human conviction. He often said, "The tape tells the truth, but only to those who can wait." That phrase wasn't just a slogan. It was a disciplined philosophy. Where most traders saw opportunity in every price jump, Livermore saw a test. The amateur reacts to the promise of movement, buying the excitement of a breakout. The professional reacts only to proof, waiting for the market to demonstrate its strength through repeated action. And that repeated action is the second break. The difference between motion and momentum became clear when observing volume. A stock could surge through resistance, producing eye-catching gains. Newspapers would call it a boom. Analysts would declare it the next big trend, and amateurs would pile in without question. But if volume dwindled on that first break, Livermore knew the move lacked power. A breakout without participation is hollow. It's a ghost that vanishes when selling pressure hits. The second break, by contrast, appears only after the market absorbs the selling from weak hands, tests its new level, and pushes forward again on increased volume. That's when the market is speaking clearly, loudly, and truthfully. That's when a trade moves from speculation to confirmation. Take, for example, a steel stock in 1928. It broke resistance at 105, with volumes surging and headlines praising the stock's newfound strength. Amateurs rushed in, buying at elevated levels, chasing momentum that wasn't yet real. Livermore, however, watched silently. The stock retraced to 101 as initial excitement faded and nervous holders sold. Most traders panicked at this pullback, thinking the trend had failed. Livermore didn't. He recognized this as the market's first test, the shakeout that separates the weak from the strong. He observed quietly, noting how the tape displayed buying interest re-entering at lower prices, how volume began to return steadily, and how sellers failed to push the price lower. When the stock broke above 106 with stronger participation, he entered decisively. That was the second break, the moment when the market revealed its real intent. Over the following weeks, the stock surged to 120. The amateurs who had bought at 105 suffered small losses or missed the true gains entirely. Livermore's patience allowed him to trade proof, not promise. This is where most traders fail. They treat trading as anticipation. They attempt to predict where the market will go rather than observe where it has already demonstrated strength. Anticipation tempts the amateur. Confirmation guides the professional. Livermore's second break strategy is a discipline in waiting for verification. He never guessed. He never acted on hype. He acted only when the tape, the price, and the volume aligned to provide clear, unmistakable proof. In his view, every trade must survive its first test before it is trusted. The first breakout may excite, but it doesn't confirm. Only the second move, validated by volume and the market's absorption of selling pressure, proves that the trend has genuine strength. Consider the psychology of this approach. Traders are often impatient, feeling a pressing need to act whenever they see a surge. They buy because they fear missing out, not because the market has confirmed a trend. This impatience ensures that they are often wrong. The professional, in contrast, treats waiting as a form of active trading. Every pause, retracement, and consolidation is an opportunity to observe behavior, not to act prematurely. Waiting allows patterns to reveal themselves fully, separating temporary spikes from enduring trends. The tape, in this sense, is a magnifying glass on human emotion, showing where greed and fear collide. The second break appears when the market has digested that collision, when the amateurs have been flushed out, and when the professionals are in control. Livermore's genius was in seeing how proof manifested in price action. It was never about intuition or luck. Volume spikes, price stability after retracements, and steady accumulation were signals that the market was ready to move with conviction. He would watch a stock flatline after its first surge, observe how traders behaved at key levels, and wait until the market itself revealed strength through repetition. The tape offered him insight into which buyers were real and which were temporary. He often described it as a story unfolding in real time. The market tests its limits once, watching to see who can hold. The second time, it tests the limit. It reveals who is strong enough to sustain momentum. This approach also required extraordinary discipline. To most, watching a stock move without taking action feels like lost opportunity. Livermore turned it into a competitive advantage. Waiting wasn't wasted time. It was active observation, and observation was a position in itself. By the time the second break appeared, he knew exactly who was in control and could enter with clarity and confidence. Most traders enter the first break with hope, the second break with proof. That difference, hope versus proof, is what separates amateurs from professionals. It's important to note that the second break doesn't happen instantly after the first. The market often pauses, retraces, or even dips slightly. This is not failure. It is the market testing conviction, the very process that flushes out weaker hands. Livermore knew that if the market survived this test and resumed its upward trajectory, the probability of a successful trade increased dramatically. Entering too early risks being swept out by minor retracements. Entering too late risks missing the move entirely. The second break is the optimal point, where the market's truth has been revealed, and the risks are clearer. The contrast between prediction and confirmation defines professional trading. Prediction relies on guesswork and emotion. Confirmation relies on observation and discipline. The first break tempts the amateur because it offers the illusion of opportunity without assurance. The second break rewards the professional because it aligns opportunity with reality. Livermore's trades weren't about speed. They were about accuracy. And accuracy, he knew, came from waiting for the market to tell its own story twice. Consider another example. A stock that had been quiet for months suddenly surges past a key resistance level. Amateurs interpret this as a sign to act immediately, fearing they'll miss the move. The professional, guided by Livermore's philosophy, watches volume closely, noting whether it supports the price or diminishes. When selling pressure appears and is absorbed without pushing the price below prior support, it signals readiness. When the stock then breaks above the previous high with stronger volume, the second break confirms the market's intent. Entry at this point is decisive and grounded in proof, not hope. In practice, Livermore's tape-reading approach required intense focus and patience. It demanded that a trader watch the market's behavior minute by minute, noting subtle shifts in volume, price, and pace. It required resisting the urge to act prematurely. Traders who chased the first breakout often incurred small losses repeatedly, eroding capital and confidence. Traders who waited for the second break preserved capital, avoided noise, and positioned themselves for larger gains. This discipline amplified returns without increasing risk. Ultimately, the second break is a filter that separates signal from noise. The first breakout excites, the second confirms. The amateur buys into excitement and fear, while the professional buys into evidence and conviction. Volume, retracements, and market absorption all serve as indicators of truth, not speculation. Livermore understood that the market's first move is a test of emotion, and the second move is a test of reality. To profit consistently, you must respect both. You must wait for the proof that comes with the second break. The lesson is timeless. Markets continue to trap the impatient and reward the disciplined. The tools may have changed digital trading terminals instead of ticker tape, but human behavior remains constant. The tape in any form tells the same story. The market tests its own limits first, then reveals strength a second time. Acting on proof, rather than promise, is the key to professional trading. By waiting for that second confirmation, traders align themselves with the market's true momentum rather than its fleeting motion. This approach eliminates guesswork. It minimizes emotional interference. It turns patience into precision. Livermore didn't trade based on what might happen. He traded based on what the market had already demonstrated. Every trade that survives its first test earns the attention of the professional. Every trade that fails its first test teaches the amateur a costly lesson. The second break is where the market speaks clearly loudly, and profitably. Waiting for confirmation also allows for disciplined risk management. By entering on the second break, the professional can set stops near pivotal levels established during the first test. Position sizing becomes more precise, risk-to-reward ratios more favorable. Every element of the trade is informed by observed proof, not speculative hope. It's a systematic approach disguised as patience. Livermore's second break principle turns waiting into an active strategy. It teaches that the market's truth must be observed, not assumed. The first breakout is noise, the second is signal. The difference between buying into the first and acting on the second is the difference between repeated small losses and compounding gains. The professional understands that the market doesn't reward haste, it rewards verification. By internalizing this, a trader gains not just profit potential, but clarity, discipline, and confidence. Ultimately, Livermore's genius lies in his understanding that trading is about timing aligned with proof. The market offers two confirmations, one to test patience, the second to reveal intent. Acting on the first is gambling. Acting on the second is professional strategy. This principle has survived decades because human behavior, the force behind price and volume, has not changed. The second break is timeless. It is the intersection of proof, patience, and opportunity, and it is where professionals make their mark. The market tests truth twice. Only the second time counts. By observing volume, price retracements, and the market's absorption of selling pressure, a trader can identify when momentum is genuine. Acting on that confirmation, rather than a premature spike, distinguishes the professional from the amateur. Waiting becomes active observation. Observation becomes evidence. Evidence becomes profit. That is the essence of Livermore's second break rule, and it is a lesson that every trader must internalize to move from hope-driven trading to proof-driven strategy. The market's behavior, recorded through the tape, provides all the signals necessary. You must simply wait, observe, and act on proof. Waiting is not weakness. Jesse Livermore knew this better than anyone. He once said, "It was never my thinking that made me money. It was my sitting." That statement encapsulates the paradox at the heart of professional trading. Action without confirmation is noise, and patience is the real position. The approaching to the real position, second break rule is not simply about observing price movements. It's about observing time itself, about understanding that the moments between the first and second breakout carry the most information. Between those 2 points lies what Livermore referred to as the psychological war zone, a testing ground where 90% of traders fail. They cannot endure silence. They crave movement, thinking that any action is better than none. Yet in that impatience, they surrender their edge. The amateur acts on hope. The professional acts on proof. Waiting is not idle. It is strategic. It is a position in itself. During these lulls, the market tests both the stock and the trader. Livermore would watch the tape flatten, the price stagnate within narrow ranges, and the chatter of news and rumor swirling without consequence. Days could pass without a meaningful move. To most, this feels like a lost opportunity, an unbearable vacuum. To Livermore, it was the most profitable period of observation. A stock resting after a sharp run is either gathering strength or quietly losing it. His role as a professional was not to guess which path it would take, but to let the market reveal itself. He said, "When a stock rests after a sharp run, it's gathering strength or dying quietly. My job is to wait for proof. Every tick, every print, every subtle shift in volume was a signal. By observing carefully during the pause, he separated noise from signal. Think of it like compressing a spring. Every day the stock lingers. Every moment it absorbs, selling and consolidates, builds potential energy. The first breakout has tested enthusiasm and flushed out weak hands. The second break is the spring's release, a decisive move propelled by conviction and trapped emotion. That is where patience converts into opportunity. The amateur interprets the pause as stagnation or loss of potential, often forcing early entries that result in marginal profits or losses. The professional interprets the pause as a filter, a way to distinguish meaningful moves from deceptive spikes. Every day of waiting adds clarity. Every moment of inactivity becomes information. The psychological challenge of waiting cannot be overstated. Humans are wired to act. The instant gratification of price movement triggers greed, while retracements trigger fear. Most traders will enter impulsively, fearing they will miss a move, only to be trapped when the market retracts. Patience requires resisting that impulse, trusting that the market will reveal its intent in due time. Livermore's brilliance was in transforming waiting into active observation. By monitoring the tape during periods of inactivity, he wasn't passively doing nothing. He was actively gathering intelligence. He understood the difference between mere time passing and time providing insight. He was in due. Each pause tested both the stock and the trader, and only those willing to endure it could capitalize on the subsequent surge. Consider a scenario. A. Stock breaks out initially, excites the crowd, and then consolidates for several days. Volume dips, prices hover near a previous high, and many traders grow anxious. The amateur sees stagnation and decides to enter anyway, chasing a profit that may never materialize. The professional, guided by Livermore's principle, watches. He notes whether selling pressure is absorbed or whether the market falters. He observes the character of the tape, the flow of orders, and the subtle signs of accumulation. By waiting for the second breakout, he positions himself at the point where probability has shifted in his favor. This approach requires faith in the process and trust that clarity will arrive at the right moment. Livermore's understanding of time as a position also allowed him to reduce risk without compromising potential reward. By waiting, he avoided entering on false breakouts, thereby minimizing exposure to sudden reversals. His stops were determined not by guesswork, but by observed pivot points tested over the waiting period. Each decision was grounded in evidence gathered while the stock rested. The pause allowed him to measure the market's strength and the resilience of sellers. When the second breakout arrived, he could enter decisively, confident in both timing and direction. Waiting thus served as both a filter and a protective mechanism, a way to align patience with profit potential. The pause between breakouts also amplifies opportunity. By filtering out noise and weak hands, the market ensures that when the second break occurs, it carries momentum with it. Traders who waited can enter with lower stress and higher confidence. The price move is clearer, cleaner, and driven by conviction, not by fleeting emotion. The second break is unmistakable, fueled by trapped amateurs who sold prematurely and professionals who accumulated quietly. Livermore recognized that entering at this moment maximized the probability of a successful trade, while minimizing exposure to volatility generated by false starts. Patience, in this context, is not a delay, it is a preparation. Patience as a position also has profound psychological benefits. Traders who act impulsively suffer repeated small losses that erode capital and confidence. Traders who wait for confirmation experience fewer losses and more decisive wins, reinforcing discipline and clarity. Livermore viewed trading as a game of endurance as much as strategy. Waiting tested his resolve, sharpened his observation, and gave him an edge over those who rushed. He saw that the real battle is not against the market but against one's own impulses, and that patience is the tool to win it. He often observed that the market does not reveal its intentions immediately. The initial breakout is emotional and misleading. Only by allowing time to pass and observing how price and volume interact can a trader distinguish real moves from false starts. During the pause, patterns become evident, weaknesses are exposed, and the underlying trend either solidifies or falters. Patience allows traders to capture these nuances, which are invisible to those acting on the first breakout. This waiting transforms uncertainty into actionable intelligence, enabling more informed entries that align with market momentum. Livermore also recognized that time in itself conveys information. Each day the market consolidates is a test. Are sellers exhausted? Is accumulation occurring quietly? Are buyers confident enough to drive price higher? These subtle signals are imperceptible without attention and patience. Most traders ignore them, acting only on visible motion. Livermore's edge was seeing beyond immediate price action, reading the tape as a record of human conviction, and interpreting pauses as an active phase of trading rather than an absence of opportunity. The waiting period is also an opportunity to align trading decisions with broader strategy. Position sizing, risk management, and contingency planning all become clearer during consolidation. By refraining from action until the second break, a professional can determine optimal entry points, stops, and scaling strategies. The amateur, lacking patience, may enter with oversized positions at suboptimal levels, increasing risk and reducing potential reward. Livermore's discipline allowed him to leverage the waiting period to structure trades intelligently, turning the interlude between breakouts into a strategic advantage. Ultimately, treating patience as a position separates professionals from amateurs. The second break is not merely a technical event, it is a psychological victory. Traders who wait learn to tolerate uncertainty, observe carefully, and act decisively when the market has revealed its intent. This approach transforms inaction into active intelligence gathering, ensuring that every entry is grounded in confirmation rather than speculation. The pause between breakouts is where the market proves itself and where the disciplined trader gains control. By viewing time as a weapon rather than a cost, Livermore leveraged periods of inactivity to sharpen his understanding of market dynamics. He understood that while others floundered in anxiety during consolidation, he was gaining insight. The second break would arrive unmistakably, and when it did, his patience allowed him to enter cleanly, with clear risk management, and the probability of success tilted heavily in his favor. Waiting is active, inaction is informative. Each tick of the tape during the lull provides intelligence that accumulates into decisive advantage. In the end, patience is the hidden edge that enables the second break to become profitable. The first breakout may excite, the pause may frustrate, but it is the disciplined observation during this time that separates amateurs from professionals. The market's second movement is the confirmation, the moment when evidence meets opportunity. Traders who can endure, observe, and wait transform waiting into profit. Those who cannot fall prey to impulse, chasing false starts and suffering losses. Patience is not merely a virtue in trading. It is the position from which every professional profit originates. Once Livermore identified the second break, the moment of confirmation, he didn't commit his entire capital all at once. Entering fully at the first clear signal might feel decisive, but in reality, it's reckless. Livermore understood that markets are dynamic, and trends reveal their strength gradually. He practiced what he called pyramiding, starting small, proving the position, and then adding incrementally, as the market validated his thesis. This wasn't a casual decision. It was a disciplined, systematic approach that allowed him to compound gains without exposing himself to unnecessary risk. To Livermore, the tape was never a suggestion, it was proof. He explained simply, "I add only after the market proves me right." That principle guided every step of his trades and kept emotion entirely separate from execution. Imagine buying 500 shares on the second break. The price moves in your favor, confirming strength with supportive volume. Livermore wouldn't add a massive position immediately. He would wait for another advance of 2 or 3 points, with the tape showing consistent, professional buying. Only then would he add another 500 shares. Each addition was predicated on confirmation, never on hope, fear, or overconfidence. His stop-loss always rested beneath the last pivotal point. He never averaged down. He only increased exposure when momentum and proof aligned. This is a critical distinction. Amateurs double down on weakness, hoping the market reverses in their favor. Professionals pyramid into strength, aligning exposure with confirmed trend. This is the difference between gambling and compounding. Pyramiding is not about acceleration, it's about discipline. Each new addition validates the prior move and magnifies gains proportionally to the market's demonstrated strength. Livermore's genius lay in his ability to scale without losing control or becoming emotional. Every increment was based on what the market had already proven. By adding only when confirmed, he avoided the psychological pitfalls of greed. Each addition became a reward for validation, not a reaction to hope. Over time, this method turned trades into compounding machines. What might have been a modest gain on a single entry evolved into exponential profits as the trend unfolded. Consider the advantage of pyramiding from a risk perspective. By entering in measured steps, Livermore minimized exposure to false signals and managed stops more effectively. Each layer of added position was smaller relative to the growing confidence the market provided. If the trend faltered, he could exit with a profit on the initial portion, while limiting losses on later additions. By contrast, an amateur who loaded up entirely on the first signal risks a complete reversal, eroding gains or even capital. Pyramiding aligns exposure with confirmation, turning patience and observation into a leverage of compounding returns rather than reckless speculation. This approach also created a psychological buffer. By adding in steps, Livermore remained calm and focused, never pressured by market swings. He avoided the stress of having all capital at risk at once, and he never needed to chase the market. The tape dictated pace, not emotion. Each incremental addition reinforced his confidence because it was grounded in proof, not hope. This made his trades psychologically sustainable over days, weeks, or even months. Professionals can endure volatility because their entries are validated by the market. Amateurs, untrained in confirmation, react emotionally and suffer repeated losses. Another advantage of pyramiding lies in market perception. By the time the broader crowd recognizes a trend as genuine, Livermore often had significant positions already accumulated. He had entered during moments when the market confirmed strength quietly, before headlines and amateur attention inflamed volatility. This front-running of perception was not about acting early without confirmation. It was about aligning with proven momentum. When the crowd finally catches up, he has already compounded gains with minimal stress. Professionals see opportunity in the market's proof. Amateurs see it in the noise. Pyramiding is a method of exploiting that asymmetry systematically. To understand pyramiding fully, it helps to examine its mechanics in a practical example. Suppose a stock breaks past resistance at 50 on the second break. Livermore purchases 500 shares. The stock moves up to 52, confirming strength with rising volume. He adds another 500 shares, using the same discipline. The stock advances to 54 with another surge in volume, and he adds a final tranche. His stops remain beneath the most recent pivot points. Each addition is deliberate, measured, and validated by market behavior. By the time the stock hits 58, he has compounded his position substantially, with minimal stress and maximum alignment with market momentum. Each increment was a calculated step, never an emotional leap. Pyramiding also mitigates the risk of being wrong. A trader who invests fully at the first sign of a second break without scaling is vulnerable to sudden retracements, news shocks, or early exhaustion of momentum. Livermore's method spreads risk across multiple confirmations, ensuring that exposure grows in proportion to evidence of strength. This scaling method is not merely tactical, it is strategic. It leverages the market's own validation to guide the trader's actions, turning observed proof into disciplined compounding. The beauty of pyramiding lies in its simplicity and consistency. Add only when confirmed. Never anticipate. Never act on hope or instinct alone. Each addition must be supported by the tape, by volume, and by price action. This method transforms professional discipline into leveraged advantage. By compounding only on confirmed strength, Livermore avoided the common pitfall of overconfidence that plagues so many traders. The market itself dictated the pace, leaving no room for guesswork. It's also worth noting that pyramiding reinforces patience. A trader must wait for the market to prove itself with each layer before adding. This is an extension of the waiting principle that governs the second break. By scaling gradually, the trader internalizes discipline, sharpens observation, and avoids the psychological traps of early overcommitment. Each step provides reinforcement, building confidence, without encouraging arrogance. Pyramiding is patience, translated into growth measured, strategic, and compounding. Another crucial point is stress management. Entering fully on the second break exposes a trader to unnecessary emotional swings. A sudden pullback could create panic, even if the trend eventually resumes. Livermore's incremental approach minimizes emotional exposure, allowing him to respond rationally to each confirmation. Each addition is psychologically smaller than the potential total position, making the trade manageable and sustainable. This is why professionals endure volatility, where amateurs panic. The principle of pyramiding also aligns perfectly with risk-reward management. Each added position occurs after confirmation, reducing the likelihood of being wrong. Stops are placed beneath pivot points established during earlier increments. Each layer of the trade is risk-controlled and evidence-based. This ensures that potential losses are contained while gains are maximized. By compounding gradually into proven strength, Livermore turned risk management into a built-in feature of his strategy. By the time the broader market recognized the trend, Livermore's positions were already substantial. He had entered at multiple points, each validated by proof, without succumbing to the pressure of acting prematurely. His stress was minimal, his confidence high, and his profits compounded naturally. The amateur, by contrast, entered en masse with emotion, often too late, and without risk control. Pyramiding systematically converts confirmation into advantage, discipline into leverage, and patience into compounded profit. Finally, pyramiding highlights a key lesson in professional trading. Don't add because you're confident. Add because the market confirmed. Confidence is fleeting, often driven by hope or emotion. Confirmation is reliable, grounded in proof. Livermore's genius was in exploiting this principle repeatedly, consistently, and without deviation. By observing the second break, waiting for evidence, and then pyramiding cautiously, he created a system where discipline, patience, and proof intersected to produce exponential results. This method turns every trade into a controlled, compounding opportunity, aligning the trader's actions with the market's intent. Every real move ends the same way. It begins with deception. Just as the first breakout lures the crowd with a promise of strength, the last rally entices traders into believing the trend will continue indefinitely. Jesse Livermore called this phenomenon the fade. It is subtle, quiet, and easy to miss if you are focused solely on price or headlines. The tape, however, tells the truth. Livermore watched the behavior of the market with obsessive attention. Smaller spreads, erratic volume, hesitation after new highs, and weaker participation all signaled that momentum was faltering. To him, these were not cues to add to positions, but warnings to prepare for exit. The fade was a professional's cue to act, while amateurs remained blinded by the illusion of relentless strength. Professionals exit while the crowd is still believing. That is the paradox. Livermore often liquidated positions on what looked like the strongest day to the untrained eye. Headlines would trumpet new highs, charts would appear bullish, and amateurs would rush in for fear of missing out. But strength without follow-through is weakness disguised. Momentum dies quietly, without fanfare, without a bell ringing to mark the end. Only behavior changes. The tape reveals hesitation, subtle retracements, and a slowdown in volume. Livermore used these signals as confirmation of the trend's end, the fade. His second break principle worked in reverse. Just as a confirmed breakout validated strength, a failed follow-through validated weakness. When a market made a second attempt to rise and failed, he sold decisively, without hesitation or regret. Consider the psychology at play. Traders are naturally inclined to cling to gains, to hope that a trend continues once it has delivered profit. The amateur sees new highs and believes the market is infinite, adding to positions in the final stages. The professional, guided by observation, recognizes that momentum requires participation. When that participation falters, when the tape softens and advances fail to sustain themselves, it signals exhaustion. Waiting for the second failure, the fade is the market's way of proving weakness, just as it proves strength during the second break. By using proof rather than hope as a guide, Livermore avoided the common trap of being late to exit and losing accrued gains. A classic example can illustrate this principle. Imagine a stock that has surged from 80 to 120 over several weeks. On the surface, everything appears bullish. Volume is solid, price is at new highs, and sentiment is euphoric. Amateurs believe in infinite continuation and continue buying, convinced they are riding the wave of the trend. Livermore, however, observes the tape and notes subtle signs. Spreads narrowing, volume thinning, hesitation near the peak. He waits for the market to attempt another rise, a second move toward a new high. When this push fails, he sells a substantial portion of his position. By exiting at the second failure, he captures maximum gains before the trend visibly reverses, avoiding the panic and forced liquidation that often plague amateur traders. Livermore treated every trade as having two proofs, one to enter and one to exit. Entry confirmation came with the second break, demonstrating momentum and professional accumulation. Exit confirmation came with the fade, demonstrating waning conviction and the market's exhaustion. Ignoring either phase meant paying tuition to the market. Traders who enter without proof risked early losses. Traders who exit without proof risked giving back gains. By adhering strictly to confirmation in both directions, Livermore minimized unnecessary exposure, preserved capital, and maintained a disciplined approach to compounding profits over time. The fade also reinforces the principle of patience. Just as waiting between the first and second break allows the market to reveal strength, waiting for the second failure allows it to reveal weakness. Attempting to predict reversals or acting on fear leads to erratic exits and emotional losses. The professional observes, confirms, and then acts decisively. The tape becomes the arbiter of truth, guiding when to increase, when to hold, and when to leave. In this sense, patience and observation are as important in exiting as they are in entering. The market provides the confirmation. The trader responds accordingly. Another dimension of the fade is its relationship to market psychology. By the time the amateur believes the trend is unstoppable, the professional is already reducing exposure. The crowd's belief signals the final stage of a move. Trapped emotion is at its peak. Liquidity is drying up, and the probability of reversal rises. Exiting during this phase maximizes capital preservation and positions the trader for future opportunities. Livermore viewed the fade as a natural and predictable endpoint of a trend, not as an aberration or random event. Understanding this rhythm allowed him to avoid the emotional swings that destroyed less disciplined traders. The fade is subtle, often invisible in raw price charts without context. It requires attention to the behavior behind the numbers: order flow, volume, spread, and timing. Small inconsistencies, hesitation after a new high, declining participation, erratic movement signal the end of professional support. Entering or holding through these signs is speculative and dangerous. The second failure confirms these signals. Just as the second break validated strength, the second fade validated weakness. Livermore's genius was in applying the same principle symmetrically. The market proves itself twice, once to justify entry, once to justify exit. Timing is critical during the fade. Acting too early risks giving up further gains if the market temporarily pauses and then resumes the trend. Acting too late risks erosion of profit as the trend quietly reverses. By waiting for the second failure, Livermore balanced these risks. The market confirmed its exhaustion. He responded decisively. This method transformed exits from reactive gambles into disciplined actions aligned with evidence. Profit preservation becomes a proactive strategy rather than a defensive afterthought. The principle of confirmation in exit also reinforces risk management. Stops and pivot points can be adjusted using the fade. When the second failure occurs, it establishes a new pivot for risk assessment, providing a logical point to liquidate positions without speculation. This systematic approach ensures that capital is preserved and redeployable, allowing the trader to maintain liquidity for the next cycle of opportunity. Amateurs, acting on intuition or panic, frequently fail to establish such logical exits, resulting in lost profits and emotional stress. Exits based on the fade also maintain consistency in strategy. Just as entry requires confirmation to avoid false starts, exit requires confirmation to avoid premature liquidation or emotional missteps. Livermore's cycle of observation, confirmation, and action created a self-reinforcing framework for trading. Waiting, observing, and responding to the market's proof governs both sides of a trade, ensuring that decision-making is systematic and evidence-driven rather than speculative and emotional. The fade teaches another professional lesson. Momentum ends where belief begins. When the crowd becomes convinced of continued strength, professional accumulation is complete, and liquidity thins. These conditions mark the end of favorable risk-reward scenarios. By observing these signs, the trader exits efficiently, capturing maximum gain before the reversal accelerates. This is the mirror image of the second break. Entry relies on proof. Exit relies on proof. Discipline and observation govern both phases, creating a rhythm that sustains long-term success. Ultimately, Livermore's application of the fade completes the loop of his second break principle. Confirmation governs both entry and exit. Waiting allows the market to reveal strength. Waiting allows the market to reveal weakness. Acting on proof, not promise, ensures that trades are entered and exited in alignment with market behavior. Capital is preserved, profits are maximized, and the psychological burden of uncertainty is minimized. The market proves itself twice, and the professional responds accordingly. By integrating patience, observation, and confirmation, the fade transforms exits into structured, high-probability actions. The tape becomes the guide, the market provides the proof, and the trader executes based on evidence rather than emotion. Professionals exit as the crowd believes. Amateurs exit when panic forces them. Understanding the fade is essential to preserving capital, maintaining discipline, and preparing for the next cycle of opportunity. It is the final proof in the rhythm of professional trading. Momentum ends where belief begins. By recognizing the second failure, the fade, Livermore ensured that his profits were captured, his capital preserved, and his strategy remained aligned with market reality. This disciplined approach to exits completes the symmetry of the second break principle. Waiting, observing, confirming, and acting decisively in both directions. Professionals understand proof governs both entry and exit, and by following this cycle, they maintain control, maximize gains, and survive to trade another day.